Larry, you were the main event here at the Morningstar Investment Conference in Chicago. I watched your keynote Q&A this morning with some 1,500 to 2,000 other people, and I heard you. You were beating the drum for equities. You, a mortgage trader, a man who founded a fixed income shop. What's the big deal about equities?
I think we are becoming a world of investing for the short term. We are focused on short-term pain. There's a lot of tail risk in the world, and so we're all just focusing on it. But if you have to achieve the necessary returns to meet your retirement, to meet anything that is long-term, you're not going to make those returns owning bonds. And there's no question we're going to have volatility, as we've seen in the last few weeks in equities. I'm not here to tell you what your entry point is, but I like the entry point here. The fact is you're going to earn 7-8% after dividends with a global portfolio of equities over the next 10 years, and I believe it's a better return environment for equities today, and I believe bonds are going to be supportive of the equity market. Interest rates are going to remain relatively low.
Do you think you'd be a buyer at this point? Is that to say that you think that 7 to 8% return, total return with dividends that you envision for stocks is something that we could achieve this year, or is that a lost cause?
No, I think we could achieve it even this year, especially with a 7% decline in equities already from 3 weeks ago. I mean, equities were up 7-8%. They're pretty close to flat now.
Right. S&P 500 up only 1% on the year.
But they were up 7 or 8. So we lost that, and so we're back.
Now, help me here, because you're not exactly bullish on the economy. There are some bulls out there. I wouldn't put you into that camp.
No.
How do you reconcile your view on the economy with your enthusiasm for equities?
So we believe equity is going to grow, the GDP is going to grow 2-ish%, which translates...
This year?
Yeah, this year.
And what about next year and years
Maybe
after?
2.5, 2. It's going to be a low.
This is a medium to long-term view.
Especially if we cut our deficits. If we cut our deficits, I may be wrong, and they may be a little lower. And so if we cut our deficits...
Hang on a second. We're talking about growth, Larry, in the 1% neighborhood?
If we do not create a partnership with business, we don't get business building back in the United States, if we cut our deficits like we were talking about, it will.
That's the future for the next 10 years, 1 to 2% growth.
And I'm going to say 2 to 3, because I do believe business will pick up, and I do believe we are going to have we're going to participate more in global growth as our companies are selling more overseas.
But that's modest nonetheless.
I believe it's fair to say we're going to have modest growth for the next 5 to 10 years.
Okay, so let's fill out the equity equation. Generally speaking, right? For stocks to rise in price, companies have to grow profits. For companies to grow profits, the economy has to expand. If we're in a 2 to 3% GDP growth environment, how do companies generate meaningful profit growth?
Well, they do it through the expansion of their business model overseas. They're selling more products overseas. And I'm talking about a global portfolio of stocks, not just U.S. And I think it's fair to say the world GDP is going to grow faster than 2 to 3. The world GDP may grow 3 to 4, 4 to 5. You put that all together, a global portfolio of equities with dividends. Dividends in the large cap companies are 2.5%, 3%. You're going to be able to achieve that 7-8% return.
Larry, where do banks fit into the equation? The bank regulation debate is alive and well again this week. What role do banks need to play? Is it true that the Fed is being too hard on banks, constraining their ability to do business?
I don't see that. The big banks already have 10+% Tier 1 capital today. And so even what was proposed by the chairman this week, in most cases, the banks have that adequate capital already. The reality is, if we regulated ourselves properly, you don't even need 10% equity. You maybe only have 5%, tangible equity. But because of the results of 2008, we are expanding that capital base just in case. But I think what we're forgetting is banks actually play a smaller role in the economy because of the capital markets. So more and more companies have access to capital in the corporate bond market.
They're disintermediating the banks.
And the banks are part of it. They own the dealer desk that's doing it. So it's not that they're being disintermediated. It's moving from balance sheet product to the capital markets product. We've seen a surge in high yield issuance. We're seeing record amount of IPOs in Asia. We are seeing capital access, whether it's equity or fixed income, worldwide. And so we have vehicles to grow our economy in the capital markets. The key where we are struggling, in my mind, is in the middle market lending, the small business, who they don't have access to the capital markets, and they are going to be more dependent on banks.
So what is your message then to the CEOs on Wall Street, all of whom you know well? Banks simply have to live with less profit growth and a lower ROE?
No, because here's one myth, and I think no one's focusing on it. I actually think banks' profitabilities can grow even with higher capital. So I, as a big bond investor, if I know that these banks are going to have much greater tangible equity, and if the government tells me they're too big to fail, therefore they will survive, I, as a bondholder, I'm more protected.
So cheaper cost of capital.
So if a JP Morgan has the ability, to name one who's been in the news, with this higher capital standard, have a lower funding cost, they will benefit hugely. And I just don't think people are focusing on that point.
Let's go back to the economy for a moment, because again, 2 to 3% GDP growth over the medium to long term is what you're envisioning.
Here in the United States.
That sounds like the kind of environment that would be good for a bond buyer, no?
Yes.
Excess capacity in the economy, limited inventory building, no wage pressure, persistent unemployment. So why wouldn't you want to own treasuries instead of equities? No inflation. Sounds like
my
a good
view
market
is,
for a bond buyer.
I'm not saying bonds are bad. I am not saying bonds are a terrible investment. I'm saying with the liabilities that people have, they need to earn more than bonds. So I'm not imputing that bonds are bad. I am imputing bonds are going to be actually favorable for equities. The fact that the bond world is not going to be so terrible, that's a good environment for equity. So the translation is not that I'm bearish on bonds. The translation should be bonds are going to be at least neutral for equities. I like that.
Speaking of bonds, we have to acknowledge this. You made the right call on the Treasury market. You and I talked not that long ago, a few months ago, Treasuries were trading, 10-year yield was at 3.5%. You said, I'd like to buy more at 4%, but I think they could continue to rally, and they did. And as has become very public knowledge, Bill Gross was wrong. And that opposing view has cast the BlackRock PIMCO rivalry into very sharp relief. What I wanted to know from you is, do you embrace that rivalry?
Not at all.
Not at all.
No, you guys.
You don't secretly smile when Bill gets it wrong for the sake of your own investors, for the sake of your own business.
I would say, they are an incredible, great investment firm. Bill Gross has been right for many years. He deserves his reputation. I think BlackRock deserves our reputation. There are calls that he's been right and we've been wrong. You know what? It's a big time. There's a big world out there. I'm not worried about PIMCO. I think they're a fine firm, and I'm not worried about BlackRock.
Well, I know you're not worried about BlackRock. Much of what you've just told me sounds like Larry Fink, the CEO. I want to go back to Larry Fink, the trader, for a moment, because you've said some very provocative things about Europe. You told us last week, in fact, when you were traveling in Asia, that Europe needed to recapitalize its banks, an urgent problem, and that European sovereign risk is still a massive systemic issue for the world. And I take it you still hold that view. It's
only gotten worse. In the last week.
Euro dollar at 144. Is that a massive sell?
I think so.
Really?
Yeah. I mean,
are we going back to the days of euro dollar at 120?
I don't. You know what? It depends how they orchestrate this. They, the Europeans. If there is a default, which would lead to bank, solvency issues, it certainly can, which I think is bad for the U.S. I actually love the dollar at 144 for the U.S. and our manufacturers.
So how do you, for the sake of American manufacturing, makes them more competitive?
And jobs.
How do you protect your investors? What are you doing to either reduce European exposure in your global portfolios or hedge against some of that euro currency or euro economy risk?
We don't own, other than for maybe a short-term trade, but we have a systematic reduction in all the main peripheral bonds. I think there's going to be a lot more pain in the peripheral, which will lead to problems. Many of our investors who invest with us in global portfolios, we do hedge currency with them, and some of them want that currency exposure. So it really depends on the investor's needs. So obviously currency plays a huge role in your total return, and it really depends on the client's needs. We have the ability to hedge out the currency or let them roll with the currency's ups and downs.
Larry, always great to talk with you. Thank you for spending time with us.